Well, hi, I'm going to talk about financial ratios, um, which are a very, very important component that's actually used in a lot of analysis, especially fundamental analysis. And within my models, I actually do use it along with some of the other things that I've already mentioned, such as technical indicators and also some macro analysis or uh, measurements that are actually going into my models. Such as interest rates and even currencies and all that good stuff. But I wanted to touch on financial ratios. I'm going to show you a couple, and there are many more than just a couple that I'm about to show, and I'll have other videos that actually will show the other ones. But they're great to show because they're all, I mean, and depending on the ratio, they tie into the balance sheet or the income statement or the cash flow statement, and sometimes they actually cross between them. And they're really, really great to see how the company is doing from an operational standpoint, obviously from a financial standpoint, and how efficient, based on the ratios they are relative to their industry and relative to some of their peers and some of the other better companies out there. They may not be in the same industry. They could be in the same industry, obviously, which is the right comparison to make, but you can also put them up against some of the best companies out there. And again, all of these are really, really important to really measure, where the company is at right now and possibly where they're going based on their ratios. And you can look at the ratios over time. Obviously, if you're looking at the past history of the company and the financial statements, you can actually be calculating the ratios over many quarters within several years. And you can actually be looking at different trends based on those quarters and those years that could actually have implications going forward. And so again, they're very, very relevant. And so let me focus on two right now. And then we'll, like I said, we'll talk about other ones and other videos. So the two that I'm going to talk about, the first one is actually the current ratio, which is actually the current assets divided by the current liabilities. And when you do this calculation, you actually look at the difference between the beginning of the year and the end of the year for both assets and liabilities, current liabilities, and then you divide the assets by the liabilities. And anything that looks very doubtful, especially in the calculation for the current assets, even current liabilities, you should remove that calculation from the actual numbers. And the great thing about it is what you're doing with this current ratio is that you're looking to see if the company, based on its current assets, can actually meet the obligations of the current liabilities. And that's really, really important. So you need to see current assets uh, over or higher than current liabilities. I mean, along the way, you may see some deviations where maybe current liabilities dip above the current assets, but over time, current assets should be higher than the current liabilities. A sound company is always going to have their current assets above current liabilities. And at the bottom of my last bullet actually shows some different benchmarks, such as retail, technology companies, industrials, and utilities, and where you might see their current ratio uh, measurement at. And technology companies usually have, one of the higher ones because they just, again, their current liabilities are usually a lot less than other industries. And most technology companies, especially fast-growing technology companies, is going to have quite a bit on the current asset side. In fact, maybe a lot of it could be at cash basis. So that's current ratio. And then the next one that I wanted to show is a quick ratio. And the only difference between this one and the current ratio is that you back out the inventory out of the current assets. Uh, because in many cases, the inventory may not be as liquid as what you might think, and especially older inventory. And so the quick ratio is really looking at the most liquid assets over the current liabilities. And so by removing inventory, which can be a very large portion actually of the current assets, obviously that's going to drop the ratio to a lower level than what you had with the current ratio. Um, and so if you look again, same benchmarks, retail, technology, manufacturing slash industrial. Then in this case, I have also healthcare, which is a little different. But they're less, but again, you shouldn't see a very, very small ratio relative to liabilities. You still want to be close to one as much as possible, even above one if you can. And again, it's just a way to see how if the company is able to meet some of its short-term obligations. That's what you're looking for with the current ratio as well as the quick ratio. It's not the most important ratios, but if if the company is borrowing money, this is one of the things that they do look at. But as far as from an analysis standpoint, to actually measure the value and the valuation as far as on the company itself and then what it might be going forward, this is not the two ratios that you would actually put a lot of weight on. And that's it for this session. And again, we'll pick up on some other ratios in future videos.